Welcome to Ping 24 Updates, your daily dose of what's happening around the world. Subscribe my channel and press the bell icon for more updates. On August 1st, 2025, a headline stunned global markets. The Philippines had overtaken Thailand in nominal GDP. The World Bank's data confirmed what analysts had suspected. Southeast Asia's economic order had shifted. For decades, Thailand was the region's benchmark for growth and stability. The Philippines, once dubbed the sick man of Asia, had now surpassed its neighbor. This wasn't just about numbers, it was a dramatic change in perception and power. The Philippine peso surged, the stock market hit record highs, and investors took notice. Meanwhile, the Thai baht dipped as confidence wavered. This was the result of years of diverging paths, demographics, policy, and global trends. Suddenly, the Philippines was seen as a new leader in Asia. In Manila, the mood was one of cautious optimism. Officials celebrated but stressed the challenges ahead. Business leaders saw validation for their strategies. For everyday Filipinos, it was a moment of national pride. Across the capital, from business districts to tech startups, there was a sense of momentum. This was not a fleeting victory, but the start of a new chapter. In Bangkok, the news prompted reflection and concern. Thai policymakers had long seen the warning signs: an aging population and political instability. The confirmation was a wake-up call. Old formulas no longer worked. Thailand's growth engine had stalled, and reinvention was now urgent. The rivalry with the Philippines was no longer theoretical, it was real, and it was now. The region's economic landscape had been redrawn. The world was watching the Philippines step into the spotlight. For 40 years, Thailand was Southeast Asia's model of development. It transformed from an agrarian society into a manufacturing powerhouse, excelling in cars, electronics, and tourism. The Thai miracle built a strong middle class and attracted global investment. Key to this success: pro-investment policies, industrial zones, and a young workforce. But the seeds of stagnation were sown early. Thailand is now one of the world's fastest-aging societies, with a shrinking workforce threatening its growth model. The country faces the classic middle-income trap. Growth has plateaued and innovation lags. Political instability, marked by coups and frequent government changes, has deterred investment and delayed reforms. Investors now seek stability elsewhere. The Philippines, with its demographic edge and policy reforms, is attracting capital that once flowed to Bangkok. Thailand's story is one of past triumphs, but present challenges. The region's economic center of gravity is shifting. The old playbook no longer guarantees success. The competition is heating up. While Thailand struggled, the Philippines quietly staged a comeback. Over the past decade, it posted some of Asia's highest GDP growth rates, often 6–7% annually. Even in global downturns, the economy proved resilient. In contrast, Thailand's growth slowed to 2–3%. The Philippines' growth is broad-based. Services, manufacturing, and robust consumer spending all contribute. A young, growing population fuels demand. The country's debt is manageable, and credit ratings have improved, lowering borrowing costs. Foreign direct investment has surged, funding new factories and infrastructure. This isn't just about money, it's about technology, expertise, and global integration. The sick man of Asia label is gone. The Philippines is now seen as a rising star in the Indo-Pacific. Deliberate reforms and digital innovation are driving the change. The numbers tell a story the world can't ignore. The Philippines' rise is built on 5 pillars. First, a young, growing population, one of Asia's youngest, fuels both labor supply and consumer demand. Second, steady remittances from millions of overseas Filipinos provide economic stability and boost spending. Third, the booming business process outsourcing sector, now a global leader, employs millions and drives middle-class growth. Fourth, rising foreign investment, thanks to reforms allowing greater foreign ownership in key sectors. Fifth, a thriving digital economy, powered by a tech-savvy, connected population. These pillars reinforce each other, creating a cycle of growth and innovation. The demographic advantage is structural, not temporary. Remittances act as a shock absorber in tough times. BPOs showcase the country's skilled English-speaking workforce. Policy reforms have unleashed new investment. The digital economy is the next frontier. Together, these factors have transformed the Philippines into a regional powerhouse. The foundation is strong and built for the future. The Philippines and Thailand are defined by their demographics. The Philippines is young, median age 25, creating a vast, energetic workforce and a booming consumer market. This youth drives innovation, tech adoption, and a vibrant startup scene. Domestic demand is strong, making the economy resilient. Thailand, by contrast, faces a demographic winter median age over 40, a shrinking workforce, and rising dependency. Labor shortages and higher social costs strain growth. The once vibrant consumer market is aging, slowing demand. The Philippines' young English-speaking graduates are fueling the digital economy. Thailand's experienced workforce excels in traditional manufacturing, but struggles to adapt to high-tech industries. Retraining is a massive challenge. The demographic clock favors the Philippines. Innovation and adaptability are now key. The Philippines is built for the future. Thailand risks being left behind. The region's economic race is now a contest of youth versus experience. The outcome is reshaping Southeast Asia. Global trade shifts are opening new doors for the Philippines. As companies diversify supply chains away from China, the Philippines is emerging as a top alternative. Its strategic location, skilled workforce, and improving infrastructure attract new factories and jobs. The country's position on major shipping lanes makes it a natural logistics hub. Investments in ports and maritime infrastructure are boosting its role in regional trade. Strong alliances, especially with the U.S., provide geopolitical stability and investor confidence. The Philippines is also deepening ties within ASEAN, enhancing its influence. In contrast, Thailand's balancing act between global powers is growing more complex. Political instability has strained some partnerships. The Philippines' clear alignments and economic momentum make it a more dependable regional player. Its voice in Asia is growing louder. The world is taking notice. The Philippines is now a key link in global supply chains. Smart policy and improved governance have fueled the Philippines' transformation. Reforms like the CREATE Act and opening key sectors to foreign ownership have attracted investment. Political stability has improved with peaceful transitions and policy continuity. Investors now see the Philippines as predictable and reliable. Massive infrastructure programs like Build, Build, Build are modernizing airports, ports, and roads. Better connectivity lowers business costs and links rural areas to urban centers. This infrastructure boom is tackling historic bottlenecks, the result of a virtuous cycle of investment, job creation, and growth. The government's focus on cutting red tape and fighting corruption is paying off. Challenges remain, but progress is clear. The governance dividend is real. The Philippines is unlocking its economic potential. The gap with regional rivals is widening. The Philippines' rise is creating new investment opportunities. The digital economy is booming. Fintech, e-commerce, and software development are surging. A young, connected population drives innovation and adoption. Renewable energy is another frontier with abundant solar, wind, and geothermal resources. The government is incentivizing green investment to build a sustainable energy future. Manufacturing is moving up the value chain. Electric vehicles, batteries, and aerospace are emerging sectors. Specialized industrial parks and ecozones attract advanced industries. Infrastructure remains a prime investment area with public-private partnerships driving new projects. There's a critical need for digital infrastructure, data centers, fiber networks to support growth. The government welcomes private capital to build the new Philippines. For investors, the country offers stable, long-term returns. The opportunity is vast and growing. The Philippines is open for business. The Philippines' new status as Southeast Asia's economic leader isn't guaranteed. Major challenges remain. Inequality, poverty, and uneven growth persist. Inclusive growth must be a priority to avoid social instability. Education and workforce skills need urgent upgrades to meet the demands of a modern economy. Infrastructure gaps, like traffic congestion and high energy costs, still hamper competitiveness. The government must accelerate reforms, fight corruption, and invest in people. The fundamentals are strong demographics, location, and a dynamic private sector. But sustaining momentum requires relentless focus. The path ahead is narrow, but the rewards are great. If the Philippines stays the course, its transformation will be lasting. The sick man of Asia is now a regional giant. The world is watching. The next chapter is just beginning.